Well, good evening, everybody, and welcome to our September 2019 Turnout Tuesday Investing Topics with Ken, Mark, and Friends. Again, this is our open format program where we basically latch on to topics of interest that are at least interesting to Ken and myself, and we hope we'll find some things that are interesting to all of you. Some of you send some suggested topics and that type of thing we've done in the past, themes of interest, that sort of thing, and we would encourage you to do that. We try to do this program every other month or so, basically whenever something kind of pops up and something we think we want to talk about. My name is Mark Robertson. I'm manager and managing partner and founder of manifestinvesting.com. I've worked with investors and investment clubs since the early 1990s. It dates us a little bit, Ken. And I'm joined here by my partner in crime, Ken Kavula. Ken is a retired school teacher, master educator, and he continues to be a wonderful educator for legions of investors, and he has for a few decades now. Thank you, Ken.
Well, thank you for the compliment, Mark. I'm ready to get started tonight. I really am interested in a couple of these things we're going to talk about. I'm interested in all of them, but especially focused on a couple of the things. So,
all right. Well, I am coming off vacation. I've been sitting with my feet up for a few days, so I was a little bit reckless today. As I mentioned, Ken's a retired educator. For those of you that are familiar with the series Breaking Bad from AMC television, that's actually a scene from the movie where the two main characters have finished their day of cooking meth, and they're relaxing with their favorite Sam Adams or Killians and some popcorn, and it's just a notion of being time to cook, back to school, and the whole series. I was stunned and amazed that I actually enjoyed it, but shouldn't be a surprise that it won baskets of Emmy awards over the years. The main character, Bryan Cranston, won Best Actor a number of times, and in this particular episode, they've just finished for the day and they're kicking back and relaxing. That's sort of what we'd like to do. This is not to imply that Ken and I endorse this sort of thing. At least not the illegal version of this sort of thing, but good, clean fun. Let's get the legal paperwork out of the way first. You guys all know the drill. No investment recommendation is intended. This is all about education. We will talk about real companies in real time. Everything we do here is for illustration and demonstration. These sessions and the stuff that we do in working with the community are known for their demonstration type purposes. Again, what we're trying to do is show some stuff that has worked for literally decades for investors and investment clubs. There are our views. We may own stocks. We'll let you know if we do. And if you'd like to be included for future versions of this webcast or the roundtables, you can send an email to nkavula1@comcast.net. That's Natalie, Ken's significantly better other half, and she takes care of the list. She will not inundate you with email, just simply a couple reminders when these events are happening. If you have any follow-up Q&A or requests, would like copies of the slides or anything else, send me an email at markr@manifestinvesting.com. Should be caught up on my email by tomorrow. I'm still digging out from a little bit less time with my computer.
our list is really growing, Mark. We added over 100 names after my trip to Atlanta, and Natalie's up close to 1,200 names now that we're sending emails to. And that's in addition to my own chapter where we send about 650 emails. So we're doing a nice job of getting the word out there for these programs.
We do like the fact that when you guys tell us you're coming, you show up. And then we also point out that we do archive the video and audio versions of these programs at YouTube. You can go to youtube.com, search Manifest Investing Roundtable, and you'll find them. There's several years of Roundtable programs. That's our monthly webcast where we share specific stocks and the analysis that goes with them, and several of these also where we tackle topics. So again, that's what we have in mind here. Just grab some themes or things we can scratch our heads about. Welcome if you're new to this. We do tend to keep it fairly informal. As Ken was talking in the green room before we started, you can raise your hand if you have audio equipment like a microphone. You can actually chat with the audience, and Ken will monitor the questions tab if you have any comments or questions along the way. But an extra big welcome if you're here for the first time. I do want to talk about this notion of investing in volatile markets. It's a request that we often get for a theme, and just want to tackle a little bit, perhaps from the side of quelling a myth a little bit about it. This morning I was greeted by one of those Monday morning emails. It happened on a Tuesday, though, because of Labor Day, from Hugh McManus. By the way, he would have joined us tonight, but he's on the way to London. Sent me a note from an industry journal about one of our favorite stocks for the roundtable, Ardelyx, and we'll take a quick look at that. Quite a day for Ardelyx and those of us that own some shares of that one. Then we'll spend a few moments with penny stocks. And it's not what you're thinking. We're going to talk about how companies react to the news that revolves around their quarterly earnings reports. And then we're just going to reinforce that it is the day after Labor Day. Between now and Halloween is our season for going after that list of faster growing core companies. We want to reinforce that unlike Ardelyx, which is a speculative special situation, we are always out there looking for those companies that still are up straight and parallel, but rapidly growing. And I just wanted to reinforce that tonight. We'll leave the floor open for some Q&A when we get done, and take it from there. Any thoughts, Ken?
Well, no, but I do want to emphasize the fact that even though we're celebrating this evening a speculative stock, I do want to emphasize that that's one of the skills that I'm absolutely terrible at. I can't remember the last time I made money when I was speculating, so I'm going to giggle and laugh and be very happy about this, but I'm not going to make a habit out of doing this, Mark, I'll tell you.
A little giddiness is okay when it comes to that. Well, let's go ahead and get underway. And again, like I was talking a few minutes ago, we get these requests all the time to come and visit with communities and chapters and groups of investors, and everybody wants to talk about investing in because the markets have become so volatile. And you turn on CNBC and all they can talk about is how volatile everything is. And this kind of takes a stab right at the heart of how that might not really be the case. What you're looking at here is a 20-year chart of what is called the volatility index, the VIX, which basically measures the roller coaster nature of all stocks combined. When their prices are moving around a lot, you go up the chart. When the prices are relatively stable, you sink to the bottom. And as you can see, the bumpiest, most turbulent time in this 20-year period is that time following the Great Recession in 2008, 2009, when the spike actually reached that peak right in the middle of the page. But the solid blue line that is through all of this is a 5-year trailing average, this solid blue line that you see here. And that's just a long-term, trailing average. And what I'd like you to notice is that it's basically hovering near all-time lows. So we actually are still in, from a long-term perspective, relatively low volatile markets right now. And it really has kind of been that way for the last 5 or 6 years. We get spikes. In fact, I would say a couple of those spikes are related to a certain person's of significant influence and his Twitter account. That's all I'm going to say. That would be this one here. Well, this one here for sure. This one here for sure. And this one here when he actually mentioned a word that included tariffs. So those have actually been kind of those spiky moments. December 2018, you can see, was a bit of a spike. But again, just this notion of, I'm not sure how much we care about this. I certainly don't even think about it on a day-to-day basis. And we don't invest in markets very often. Some of us may do some hedging and that sort of thing, but we don't invest in markets. We actually go out there and we try to find excellent companies at good prices and never stop doing that. So when somebody asks me, do you do anything differently in volatile markets? Well, my first answer is, well, are you sure they're as volatile as you think they are? And second of all, it doesn't really matter. You're not going to do anything all that differently anyhow. What are your thoughts on the whole?
Well, well, Mark, I do go to a lot of investment club meetings. I'm in three actual clubs myself, and plus my family club, and I answer a lot of things online from people. And I'd love to sit down large groups of people, starting with the CNBC broadcasters, and explain to them the difference between 1% on 25,000 anythings versus 1% on 1,000 of anythings. I mean, we seem to get in this dither about triple digit gains and triple digit losses. And in reality, triple digits really don't mean a whole lot when the Dow average is sitting at 25,000 plus, and when the S&P is sitting at the levels it's sitting in, or when the Nasdaq's sitting at the levels it's sitting in. You really need to watch the percentage ups and downs. And I always was fairly happy back in the 80s. Some people say I'm stuck in the 80s, but I was always fairly happy when the market didn't move as much as a percent either way on any particular day. Now, it didn't take many points to move it a percentage, but 12, 13 points would sometimes move it 1% one way or the other. Well, today it takes a heck of a lot more points to move it that 1%, and I would urge you not to become so fixated on the number of points that the market is going up and down, but ask yourself what the percentage going up and down is. And to be honest, in my mind, it stayed fairly consistent over a long period of time. And I think this graph just points out that we've had volatility for a long time in the market. In fact, that period, maybe 2003, 4, 5, 6, where the lines were a little bit shorter, that might be the outlier rather than the really long lines we see at regular positions throughout most of the rest of the chart. So watch the percentages, especially with stock prices, moving into the hundreds of dollars and the thousands of dollars. I know, Mark, you've been investing long enough to realize that that's a fairly new phenomena. Stocks used to kind of, by unwritten rule, keep themselves at 100 or less than 100 by doing pretty consistent splitting on a pretty regular basis. But today, that seems to be out of fashion, and so we let stock prices move to $1,000, $1,200, $1,700, and we have the extreme example of Berkshire Hathaway moving into the multi-thousands of dollars, and then actually creating a stalking stock to allow the average person to buy into Berkshire Hathaway, and the stalking stock is now even quite expensive in actual amount of dollars that you have to pay for it. So all in all, watch the numbers, watch the percentages. Don't be so fixated, like I said before, on how much it is up or down or whatever, but ask yourself what's the percentage up and down before you get really excited about some of these things.
Yeah, and in fact, we'll be talking a bit here in a few minutes about Alta. And Alta is a company that back in the days of higher brokerage commissions and round lots, which were 100 shares, there was an effort made to keep the price. Alta is basically around $300 a share now. They would have tried in the past to keep it around 30-ish on average, and they would have done stock splits to do that. So, and Ken already mentioned Berkshire Hathaway is at $310,000 per share for the A shares, and it's a company that has never split. So yeah, pay more attention to the percentages, and I'll take and extrapolate what Ken said. You can't tell much about the priciness of a stock. Alta at 300 versus Berkshire at 300,000 versus Ardelyx at $3 a share. And say which one is cheapest based on the number of dollars. You have to dig in much more deeply and calculate that return forecast in order to make those type of judgments. So I think that's enough on this one. Again, there might not be as much volatility. I will confess that in the car going to Cincinnati for the National Convention a few years ago, I bought some VIX. Um, in the car, I do this because I love all of you and I want to be, I want to be versed on this sort of thing. And I figured volatility was going up and I was right. But for some reason, I didn't get rewarded for being right. And nothing irritates me more as an investor or a speculator, because I'm a real amateur speculator like Ken. And that VIX trade didn't work out very well.
I'll tell you, Mark, if I remember that correctly, that was in the middle of a conversation where we both admitted to each other we didn't really understand what the VIX was measuring. And so you said, well, I'm going to buy some. That'll force me to figure it out. And I don't think we ever really did figure out what it's measuring. I know that it's really looking at a couple of other indexes and trying to gauge how one thing acts in relation to another index, but that's about as far as I ever got with it.
Well, when I wasn't rewarded, I lost interest. So we just move on. We just move on. All right, on to today's blockbuster good story. Uh, we will talk for a second here about industry journals. Um, can be a very interesting source of information. Hugh McManus sent me this morning. It's actually from a site called endpoints.com. You can see the web address there in the middle of the page, endpoints.com. It is a newsletter that is biotech and pharma concentrated. It's free. There is a premium newsletter attached to it, but a lot of the content appears to be available for free. And it's just a steady stream of information about pipelines and biotechs and those type of companies. But this morning's news release was on stunning, surprising success that Ardelyx has had on its chronic kidney disease treatment. And again, I can't speak to the actual specifics, but they're actually trying to use one of their irritable bowel drugs in another way for treating some of the symptoms of chronic kidney disease, and it outperformed across the board with virtually no adverse indications from the testing population and all that kind of stuff. Hugh knows all the right words, but that came as quite a surprise, and we are only a little over a week. September 12th is the actual scheduled FDA release date for the irritable bowel syndrome drug, and all indications for that are positive. So we're looking at a stock that around Christmas, December 2018, was hovering around $2 a share, and we've been watching it rather handsomely advance. And we were celebrating this morning that it had gone from $3 to just over $4, and it actually proceeded to do even better than that. This is the close of business today. It actually had reached 581, and after hours trading, it had gone to 614. So I own shares of this one. My wife and I know that Ken does, and others in the community. Hugh McManus probably owns more than all of us put together. It's always fun when one of these happens like this. So I know, Ken, you're in at around $2 back in December also. So it's kind
Yep.
of interesting to watch this happen so suddenly.
I can tell you what that other indication is, Mark. The condition is hyperphosphatemia. And what happens for patients on kidney dialysis is that the amount of phosphorus in their blood spikes. It gets to be quite large, and that becomes a problem, a real problem. And removing the phosphorus from the bloodstream is much more difficult than simple dialysis. So trying to find something that doesn't affect the dialysis and at the same time works to remove the excess phosphate from the bloodstream has been a kind of a long-term search, and this drug seems to do it, and seems to do it with very little side effect of any other kind. And that's the big plus to the drug. This is the same drug, this tenapanor, that they're going to use for irritable bowel syndrome, but it has another indicator, and the other indicator is to remove the excess phosphate from end-stage kidney patients' bloodstreams. which, if nothing else, will make the quality of life for these people a heck of a lot better. The next step now will be to do some studies to see if it has a significant effect on length of life as well as quality of life.
Excellent. Yeah, good news all around. And again, I would recommend this page. It's put out by it's a web page put out by the University of Kansas that concentrates on this area. Just for kicks, I looked through and read some articles on Regeneron Pharma, which I presented at the round table. I'm going to add it to my list of stuff to look at on a daily basis and just kind of scan. I'm kind of intrigued by that. The gentleman down on the lower left is a Vertex Kahuna, and they're talking about their quest to cure diabetes. So again, if you're a Novo Nordisk investor, for example, might not be such a bad idea to keep an eye on what companies like Vertex are doing. And I just see it as a possibly a really good thing. I would encourage everybody out there that if you have an industry journal that is worth that has investment type information, impactful information, that consider sharing it with the community. Let us know. All right. Anything else on that, Ken?
No, can you hear me now, Mark?
I can.
Okay, no, nothing, nothing else. I'm ready to go here.
Okay, so we'll high five and enjoy our Ardelyx moment and hope for a really good report from the FDA on September 12th. And maybe my vacation just got paid for. Who knows? All right, let's spend a few moments with penny stocks. And it's not the penny stocks you're thinking about. This is a tribute to Ken Janke, the multi-decade executive at the National Association of Investors, president, CEO, and chairman, ultimately my boss back in the day. And that's him on the left with his grandson, Charlie, and Lily down at the bottom trick-or-treating. He was really quite a warm guy and just a wonderful guy to work for. I took this from an interview because we want to talk about some of the stuff we see going on with earnings guidance, earnings reports, all that sort of thing. Ken used to keep a list of what he called his penny stocks, and but it's not at all what you're thinking. He basically would keep a list of companies, and you know many of the names from. Well, one of his favorites was O'Reilly, but another one was TJX, one of your favorite stocks. And he
Absolutely.
kept this list of about a dozen companies, and what he always watched for was for them to miss their earnings report by a penny. Because every time they would miss their earnings on their conference call by a penny, the next thing you would know, the stock was down $10 per share the next day, and he was buying shares. And he talks about what really is the point of that whole futility. It is a game. It's something of a game, and they can be way out of whack. I'm certain if he was around today, he would point out that some of the accounting changes that have been made haven't made this any easier with how they keep track of their investing. But again, I'll just enter this subject area with the quote that if you can keep the long-term perspective in mind, you can really take advantage of this volatility. And it does open the door to buying stocks at a bargain. The one we want to talk about is right here. Take us away,
I, I
Ken.
will I will say, Mark, that I also think that Ken was operating in a time period when we did not have program trading, and I think program trading with the different rules and the different logical things that are programmed into it, I think that's made this whole idea a lot. It's stretched it. That's a pretty good word. Stretched it so that maybe in Janke's time, a penny miss might mean a 10% loss or a 5% loss, and today a penny or a nickel miss might be as much as a 15 or a 20% loss in the price of a stock, because you have all these rules that the computers are using to trade stocks with no human intervention. And so the stock is being traded even before somebody has a chance to say, hold on just a second, what's really happening here? They're trading on particular sentences that they might read electronically in journals or in analyst reports or in newspapers or whatever. and it's made things a lot more difficult. And again, there's that word volatility. The price is going up and down. And again, in my estimation, at least, and I'm very glad to be in the company of Mr. Jenke, that maybe it's just not quite as bad as it seems when you have something that small happening over a 1/4 set of numbers. So that next slide, I think, kind of demonstrates an extreme example of what is going on right now with some of these rules, this program trading. Ulta Beauty, I love the quote you found at the top of the page, Mark. The best performing stocks aren't usually the safest, but they are right now, says Barron's on the
That's
29th
the day
of
before.
August.
The day
Right?
before the carnage. You
And
can't make this stuff up.
then Ulta comes out and has it wasn't really a terrible earnings report, but it was an earnings report that wasn't as phenomenal as you usually see out of Ulta. But more importantly, they decided they were going to withhold their guidance going forward. I don't know why yet. I hope that it has nothing to do with malfeasance, but certainly that wasn't even hinted at in any of the reporting. And yet the rules that the computers follow took this stock from somewhere around 330 down to somewhere around 240, give or take a little bit. So a $90 haircut off of a $330 stock, that's a pretty good haircut in a single day, and it might have opened up an opportunity. We'll be discussing this in both of my investment clubs coming up next week and the week after, because both clubs own Ulta. And we'll see, first of all, if there's been any recovery at that point. And then we'll also be asking ourselves, is this a buying opportunity, or has the stock really suddenly has something broken? And if it has broken, can we identify what it is?
Oh, you know what makes me sad, Ken?
What makes you sad, Mark?
Well, this stuff is hard enough without, we could write chapters on this. The stock price drops from 340 to 240, and now these people are issuing all these reports, either downgrading to a hold, a weak hold, or even a sell after it goes down, and that will never make sense to me.
No, it doesn't make sense to
It,
me
it,
either.
it will
Yeah.
never make sense to me. And again, I kind of look at this, this is a retail stock. Some of us are very uncomfortable with retail stocks. This is a good retail stock. But I think one of the things I have benefited from over the years, I'm thinking back to the experience with Buffalo Wild Wings, buying it, buying it, selling it, again over a period of about 10 years, but being willing to cycle in and out of it 3 or 4 times. And we made good money doing that versus holding it throughout that entire 10-year period. It was a pretty sizable difference, several percentage points, double-digit percentage points difference between the two. I just wonder if this isn't an example. We talked 2 months ago about Cognizant, and we talked about this relative strength index, this RSI up at the top of this chart, as being a potential indication of what the herd is actually, not what they're necessarily saying, but what they're actually doing. And on the left-hand side of this chart, back in March, there was a heavy surge of buying, which pushed that relative strength index up above 80. And it basically stayed, in that 350-ish range for the next several months, 4 or 5 months. And you could have taken advantage of that potentially a little bit inflated. We'll look at it chronically here in a second, but a potentially high inflated for a stock that you might be willing to trade more often than you would one of your core blue chip holdings that don't happen to be a retail stock. And now on the right hand side of the chart, we're back down at that 20 zone. And my inclination is not to issue a sell report on the company, it's to buy it. I will give serious thought, based on the pictures we're about to look at, to actually accumulating or actually opening a position in Alta, if for no other reason the fact that it's dropped $100 per share in price. It's crazy to me. Here's a look at some of the stuff that Ken was talking about. What actually caused the situation? What grabbed you the worst about all of this stuff, Ken?
Well, first of all, there's been a number of times. This is a price chart. Remember, it's that you're looking at. And there's been a number of times when Alta has had serious price movements in the wrong direction. You can see it happening in 2014. There was a period back in late 2017 into 2018 where we had quite a decline going on, maybe even longer than that circle suggests, Mark, that you just put on the in the 2017 time period, because there's quite a long downtrend right there. So this kind of up and down is not necessarily that new. Whether this is going to be something that is significant or not, you won't know for quite a while. But look at that relative strength line. I guess I'm becoming more and more convinced that it's telling me something. I'm still not convinced at what it is telling me. I know it's a purely technical indicator, but it's odd the way that every time it falls beneath that bottom line there, and I think that line's on 30, isn't it, rather than 20, Mark?
Yeah, the two lines are at 70 for being
And
overbought
30, yeah.
and 30 for being oversold.
Yeah.
And then, as we pointed out during the Coddington presentation, that is what the rhinos and most of the algorithm type traders are looking at. But to reduce the amount of cycling or toggling going on, if you go with 80 and 20, which is what I've been looking at for some time now, we talk about this in some of the weekly stuff that we do, 80 and 20, and when it gets down around 20, which it is now, 20 and increasing, you can see that this is over a period of 10 years. You're talking about a half dozen instances of that over 10 years. And so it's not happening, every other week. It's not a trading situation. And then you can certainly see some of these peaks, this one here and this one here where it finally dropped back below 80. And just notice that.
And there's a couple of them sitting in 2018-19 also.
Mhm.
And what I was about to finish up by saying is that if you're not comfortable with this relative strength idea, maybe you're more comfortable with the idea of PE. And I know that I've been uncomfortable with Alta, not for anything fundamental, but I've been uncomfortable with it for about a year and a half now because its PE's been in the low to mid to high 50s. And maybe that's correlating better than I want to think with this relative strength. And like I said, if the relative strength doesn't grab at you, maybe the 50 PE as kind of a selling trigger, or at least an indicator of a stock that might be ripe for tipping on the slightest negative news. Maybe that should be something that all of us might want to be a little bit more aware of as we go through and try to manage our portfolios. What is the current PE today? And are our stock watchers at our club meetings, are they really making us aware when those PEs slide into places where the stock has a much better chance of toppling over on really, fairly mundane bad news? When that's happening, I'd like to be made aware of it. And I think it's something that I'm gonna be talking to my clubs about and asking the stock watchers to come to the meeting prepared to let us know when the PE has gone over. And I don't know what the trigger is. Is it 45? Is it 40? Is it 50? Is it 60? But there has to be a place up there somewhere when I want to hear that the PE is up that high. Then we can make a decision as to whether we want to trim some of that, some of the holding, or trim all of the holding and come back into it at a much more reasonable PE and at a much more reasonable relative strength.
Yeah, and I would take the same type of thinking and use the Chronicle. I typically regard PE ratios as an extremely important piece of the puzzle, but I kind of like the end game better. And here we can break into a little crystal blue persuasion here, Ken. By the way, that song was at the top of the charts 50 years ago, everybody. But here's a look at the chronicle for Ulta Beauty. And again, this is one of those stocks, even though it's in the retail sector, um, or I should say industry, consumer discretionary for the sector, the quality has been, between 90 and 100. And it's certainly camping around quite strong here. It's a great company. But what I'd like to draw everybody's attention to is this notion of, and obviously PE drives this notion of, might this be a company where every time the par gets down around this level right here, I'm drawing the line through, let's call it 9%. Maybe a par of 9% is when I want to be notified to at least be thinking about. Maybe it's a combination of the two things. If you told me that the par for Ulta Beauty is now 8.5% and the relative strength index is up at 80, maybe that's a very meaningful, and statistical way to really skin this cat. Notice that it was down in that range, and the $100 price move that you can see on the right hand side of this chart restored the projected annual return from somewhere around 10 back to 20. All right. So again, that's not a sell situation from where I've learned to invest. That's the exact opposite. And maybe there's something that could be derived here. We could actually use the alerts on a situation, very company specific situation here now, where every time the projected annual return gets down into that upper single digits, that it might become, a candidate for discussion. Your thoughts, Ken?
Well, I'm sitting here thinking not about Ultra Beauty, but about Crystal Blue Persuasion, Mark.
Crystal Blue Persuasion.
Don't sing, Mark. Okay.
Come on, Ken, do it with me.
No. But I'm from the generation that didn't go in for the really big wedding proposal. Back in the 60s and even earlier than that, wedding proposals were much more informal, and they happened after a discussion a lot of times. And I can remember my wedding proposal was over a couple of beers at the local college bar when the two of us were almost ready to walk across the stage for graduation. And we talked about, wasn't it time to get married, because we had been dating for a long time. And I can remember Tommy James and the Shandels performing in the background as that discussion went on. So that's where my mind was the whole time.
Man.
I'm sorry.
The audience is not going to believe it, but that's the first I've heard that story.
Well, that's I don't think I've thought about it for 45 or 50 years. So
and
I agree with everything you're saying, though, Mark, that a low par is also basically saying the same thing, many times at least, as a really high PE. They're both indicators of something going on that you want to take a look at.
Yeah, and in this case, the other thing to point out is this relative return, which we don't talk about a lot. Anytime the relative return is positive, the stock is pegged to outperform the market. Notice that there have been a couple of moments here when there was some weakness, and this one in particular is kind of compelling. So a stock, when it's in the sweet spot for us, means that it's in this range here. It's basically in that 5 to 10 range. That's our sweet spot. So just something to think about. So thanks, Ken. Your crystal blue persuasion apparently worked when you asked the question. So good deal. Here's a look at the company. And again, I'm struggling to find any massive amount of weakness. By the way, the analyst updates on the expectations for 2019, 2020, and 2021 are in this chart. It's embedded in this analysis. So we're talking about a company growing at 12-ish. Used to be 15 on many of our guides, but 12-ish is still quite good. Projected net margins, somewhere around 10. You could argue for 9. 9 or 10%. So that's what you've got. You're looking at that as the second judgment milestone. PE ratio, again, probably want something in that 20 to 25 range. I went a little bit conservative. Even with those three assumptions, we're talking about a projected annual return of 14%, which ain't bad. So, company with no debt, they've got 522 million in the checking account. Um, Pretty favorable statistics. Here's that RSI approaching 20, and value lines, worst case, which will be updated, obviously, doesn't look too bad. But I see a lot of consistency in this chart, and the fact that that price has moved from the top of this price bar to the bottom of this price bar, um, just kind of feels like a Ken Janke opportunity to shop near a 52-week low to me. What are your
We have
thoughts?
we have one of my directors, Herb Lemko, just rubbing it in. They got out of it in June at 456, so he's just rubbing it in. I'm going to see Herb in person on Thursday, so I'm sure I'm going to hear quite a bit about it on Thursday. Okay. John has a question, Mark. He wants to know, what's the chance that makeup won't sell in a recession? I have my thoughts about that, but how about you, Mark?
Well, my thoughts are pretty simple. It doesn't go back quite far enough to catch the major moment of 2008 and 2009, but anything vanity related tends to be pretty recession um, uh, avoiding, or whatever you resistant. I would,
Recession proof.
yeah, recession proof. That historically has been true. Um, One of the members of the Better Investing Securities Review Committee that picks the stock to study for the magazine every month, every once in a while he would present a stock which involved male vanity, and he would just basically say, never underestimate the power and gravity of male vanity. And I think this certainly holds true for the other gender too.
I think you'd have to show me that there was a real drop off. And unfortunately, with the length of this recovery, we're not seeing what happened to Ulta during the 2007-8 time period anymore. But we certainly could reconstruct that data if we were interested in it. My feelings are just like yours, Mark, that that's probably one of the last things that a lot of people will stop spending money on, and that's anything to do with making themselves look and feel a little bit better.
All right, so those are my thoughts. I'm always amazed at when a company can drop 30 or 40%, and then we get a sell recommendation from the rhinos. But hey, some things never change. But I do think that, and again, just kind of reinforcing what you had to say, Ken. I do think that the algorithms that are in play, they really do intensify, they exacerbate, and they intensify what we see with these misses and these nebulous hedging of future expectations. It really is intensified, and so you get these quick hits to long-term situations, and it goes right back to what Ken Janke had to say. I think taken in the collective, this just has to represent opportunity to long-term investors with the right long-term perspective.
So where are we going next, Mark?
All right. Well, some people have commented that it seems like some of our small company stuff is kind of shotgun. Um, yeah, there's a little bit of shotgun where we take and try to build studies of companies. But I just wanted to remind that one of the things that we do to identify new opportunities and vetted, qualified opportunities is to watch a select group of mutual fund managers who are among the best in the business at identifying small company opportunities. And what you're looking at here is the scorecard that we use for the trailing 10-year period going back to Halloween 2009, and what the best small company mutual funds have been over that period of time. So you can see that at the very top of the list, T. Rowe Price, New Horizons, that's the ticker in the second column there, PRNHX, has gained at an average annualized total return of 19.8. That's beating the stock market, the Wilshire 5000, by 6.6%. And keep in mind that this is a segment of investing that has actually been in the doldrums for the last couple of years, small company stocks, as measured by the Russell 2000. So from top to bottom of this chart, these are people that seem to know what they're doing, and we'll actually dive in, and we'll demonstrate that here in a minute, of taking a look for some opportunities and new companies to discover.
Mark, I had a question this last weekend, or 2 weekends ago now, actually, when I was in Atlanta, and the question was, do we know of any ETFs that focus on small groups of small company stocks? Do you know of any ETFs that kind of operate the same way these mutual funds do here?
There's actually 4 or 5 ETFs that don't qualify for this list yet. Their performance is under the mutual funds on this list. I expect to see one of them one of these days erupt and actually get farther up the list. But as of right now, the ETFs that are out there have underperformed this list.
Okay, so they do exist, though, however, right?
Yeah, I can show you the list on our spreadsheet. They're just
Okay.
they're not on the leaderboard.
Okay, sounds good.
Okay, so again, using those to target, that is one of the primary ways that we find the companies. And this is your reminder, again, day after Labor Day, between now and Halloween, Ken and I will be picking our favorite best small companies for the next year. Here's how well the companies have done this year since last Halloween. I'm not going to make too much fanfare about these companies other than to point out that they have come in at about 17.5% total return since last Halloween. That beats the market by about 10%, so we're having a pretty decent run of it so far. Even though there's a couple pretty hold your nose stinkers at the bottom, the ones at the top more than make up for it. So one of the things I thought we might do is just, again, take a look. We'll come back to the coming attractions here in a bit. Thought we might take a quick look at Morningstar and just demonstrate what we mean. I'm just going to Morningstar. I'm going into T. Rowe Price New Horizons. That's been the most successful one on our leaderboard. You can see that they get 5 stars, and they're one of the bronze funds over at Morningstar. And just thought we would demonstrate how we would pan for opportunities. All I've done is clicked on portfolio. And by the way, this is all changed around, Ken. You can no longer sort by the most recent purchases and all that. I hope they fix that as they're improving the site. I'll say show more holdings, so you can see some of the stuff that they have bought over the years. Some of these names are fairly well known.
Can we sort any of these columns, Mark?
I don't believe so, unless they've changed anything. No. So
nope, that's too bad.
We used to sort the columns so that we could see the most recent additions to the portfolio, and then we would check them. Here's one that has been added to manifest within the last few weeks, Stone Co. That's actually a infrastructure application software company. And you can see that they added that for the first time in December 2018. That one actually looks a little bit compelling. We can take a closer look at that one. I've not looked at the GCI Liberty. That's one of the Malone companies, I believe. Twilio, that one's in manifest for sure. Anyhow, you notice you can see the companies. You can notice some of the companies that are high on the list. I'm not too familiar with Rent-A-Kill. That's not in our collection yet. But DocuSign is, again, added in December 2018. Eurofins, not very familiar with that one. Here's one that's actually popped up quite a bit lately, Ollie's Bargain Center. Ken, had you done some work on this one with one of your clubs?
No, except that none of the clubs that I belong to like this stock particularly. I did listen to the CEO of Ollie's on television about a week ago, indicate that perhaps they had bitten off a lot more than they could actually chew, and they were going to back up from some of their store openings because they had discovered that they were cannibalizing some of their own stores. They had jumped in with both feet into the real estate left by the bankruptcy of Toys R Us, and they had picked up 30 some odd Toys R Us locations throughout the country and opened up new Ollies there. But comes to find out that they were actually cannibalizing some of their own stores in the process. So he kind of did a public apology and said they're going to back off of opening new stores, and they're going to try to digest what they have open and perhaps close some of the stores that are actually geographically too close to each other, and that neither store is performing what they expect. So it wasn't a particularly upbeat interview, and all he did was kept apologizing for all these miscues they had made. So I don't especially care for Ollie's. I think there's competitors that do a lot better job at what Ollie's does, and I kind of have been looking at the competitors.
Yeah, and it falls into the obviously into that retail realm, and it's down 36% year to date. So again, it could be one of those. I do know that pretty sure it was Tom Gardner over at the Motley Fool featured it a couple of years ago. Be kind of interesting to see how those expectations have kind of panned out. New Relic down here, I had not ever noticed before. It's actually in a fairly recent edition of the Value Line Standard Edition now, so it's been added to coverage. And you can see this is a brand new holding. I think it's NEWR is the ticker symbol. So just for kicks, let's go ahead. You used to be able to go straight to the tickers too, and you can't do that anymore either. Let's go ahead and see what NEWR, I'm pretty sure that's right. Here's New Relic. And at least from a price to fair value situation, it's at 56 versus a fair value of 67. So could be a fairly decent, it's another software company, decent sized opportunity to take a closer look at, do an industry study perhaps of peers and competitors. And then just for kicks, I haven't looked yet, so let's go ahead and look under Brown Capital Small Management. Brown Capital Management Small Company. By the way, they're the only ones who get the title right. Small cap and small company are two different things very often. This is small company, and you can see they've got 5 stars in gold. Let's dive into their portfolio.
Mark, before you scroll right over it, I really like this stock style graph when I'm looking at these portfolios in Morningstar. And I do take a little bit of time just to take a look at what kind of stocks it is they're investing in. And I like when they're actually moving in the small area. That's not small cap, that's actually small on that nine block right there. And they're moving into the small growth area quite, that's where they kind of own, and the center's just above the small to medium line over on the 4th block over there. But I think this a lot of times shows me whether the name of the fund matches with what they're actually doing. It's a useful piece of information. I think you can spend 30 seconds on just asking yourself, is this really investing in the kind of things that I think it should be investing in?
Yeah, and they certainly qualify with small and growth pretty much across the board. Here are some of the companies in there. We're just talking about Paycom with Marie Frank in the fortune list. So Paycom is the #1 holding at Brown Small Company. Viva, community favorite. Proto, you can see a lot of companies in here that would resonate with many of us. Q2 Holdings, one that came around a little over less than a year ago. These guys do not change over their stuff very, very often. Here's alarm.com from 2018. They do not change over. They hold and fairly high conviction. I do think.
Mark,
Go
Do
ahead.
you have the opportunity to talk to anybody from Morningstar ever, Mark?
I do.
I would be interested in understanding why they've made it so difficult to take a look at these portfolios and so difficult to analyze them. I know that they've added some more information to each line, and that's a pretty little graph there that they've put onto it. But the fact that you can't sort them and the fact that you can't identify the holdings that are gone. I think those are both interesting deletions from the usability of the tool.
Yeah, and they've at least temporarily suspended their fund pages and their company report pages that we used to depend on so heavily. Um, I can't. Maybe I'm just an old dog and have trouble with change, but I'm not getting some of that. Um, just as an example of companies that are definitely worth a look, I have no idea what you will find, but here's Appfolio. The ticker is APPF. Fairly new, could be a fairly young life cycle type company, but the fact that these guys have invested $50 million in it as of a couple of months ago makes it worthy from where I sit to take a little bit closer look. So again, that's how there is some sniper-like precision in what we do when we're bringing companies. We'll be bringing companies like Appfolio and some of the others we've mentioned and adding them to coverage. Any other
Uh,
comments on that, Ken?
Herb spotted Ardelyx on this list, Mark.
Really?
Yeah. Now maybe this is an old, so maybe it was the one before, but he did spot Ardelyx on one of these lists that we were looking at right here. So, oh, maybe it was this one, Herb. It was Alteryx.
Alteryx, yeah, that's a
That's
software
that's
company.
a different company, right? So, Mark, we are kind of up to date with the questions. I'm going to back up just a little bit. Bill Thompson is telling us that on the Alta earnings call, they did lower the same store sales growth. It had been 6 to 7%. They lowered it to 4 to 6%, and then indicated that that should impact future sales growth by somewhere between a point and two, between 1 and 2 percentage points.
Mm-hmm.
That doesn't seem like a huge hit. In other words, the store growth is going to continue basically unabated. Again, for a 1 to 2 percentage point hit on sales, that's an awfully big hit on their price for that to happen. So I guess Bill is searching the same way I am for information that I can use to talk to the people in the club about, was there really any reason for all of this to go on, or was most of it algorithmic and if that's so, then the next week to week and a half should be time for this to do a little bit of recovery. I have noticed that in this time of huge volatility, when they miss by a penny or two, I have noticed that it pays as an investor, if you're going to get out at the bottom, it pays to wait a couple of weeks, because usually there is a recovery of some sort, and the recovery can be pretty interesting when it recovers a half or more of the decline in the first place. So I would urge people not to sell at the low. That's not the way we're supposed to do it. It's not buy low. I'm sorry, it's not sell low. It's buy low and sell high. So I'm hoping that people will keep their powder dry a little bit. I certainly don't think that you'll see a lot of movement in Alta stock until the next quarterly earnings, unless it nudges up, recognizing that it went down too far too fast. But with all that said and done, I don't have a crystal ball, and neither does anybody else. So where are we going to be in the future here, Mark?
All right. So Ken and I will be talking with a group of investors in Portland over the internets on September 14th. That's a couple weekends away. The next investing roundtable is on September 24th. Should be fun. By the way, today's price action in Ardelyx moved it up to the eighth most valuable stock in the portfolio. So that's fun looking at
Okay.
that. And for all you fellow groundhoggers out there in our annual groundhog contest, of which I am one, if you have Ardelyx in your groundhog portfolio, high five me because we are moving up the list. The other fun fact from today is that the gain in Ardelyx offset all the other losses in the portfolio for the roundtable tracking portfolio. Stock markets were down like 1%, so Ardelyx overcame all of that in one day. So that's fun. All right, Sai's going to be in Charlotte on October 26th on the eve of Halloween. The October roundtable will be right around Halloween, so we'll certainly be having some fun with that. Ken and I will be in Seattle on November 9th for their annual investors fair. The Mid-Michigan Stock Pickers Breakfast, which has got to be what, the 15th annual, Ken, or something like that?
Something 14th, 15th, something along those lines. And Mark, I'd like to take the opportunity to welcome to the Mid-Michigan chapter the Capital Area chapter. As of October 1st, the Capital Area chapter is going to become a part of the Mid-Michigan chapter. And we're going to be expanding our territory into Lansing and further south down to the Ohio border. So if you're listening from that particular area and you'd like us to come visit, you'd like us to do something that maybe hasn't been done recently, don't be afraid to drop me an email and just ask for a club visit or ask for some services, and the Mid-Michigan folks will see what we can do. We're very excited to bring in those members, and we hope to offer them the same kind of service that we offer to the current members of the chapter. That's going to allow us now, Mark, to go from the Ohio border all the way up to the bridge at the Mackinac Straits and all the way up to Sault Ste. Marie. So we got a big stripe right out of the middle of Michigan right now.
Well, if I can help, I'll have a home base in Lansing here pretty soon. So
Terrific, terrific.
for the kids. All right, so the rest of those dates are out in 2020, and again, we're talking to a few other blocks of people that have expressed interest in us coming out and chatting. But we always enjoy it. It always invigorates. It exacerbates and intensifies us in the realm of investment education, and we thank you for that.
Yeah, Mark, Jane Johnson is making a really great point. She's talking about a stock that's been a favorite of ours. It's on our small company list this year. It's doing quite well, and it's been a favorite of ours for 4 or 5 years, and that's OLED. The name of the company is Universal Display. Looks like it's 5th on this list right here, right now. And she said that take heart that OLED lost half of its value a couple of years ago, and it's now back up again and still growing. It's a real great stock. I had the pleasure of talking with Jane's husband at the convention in March, and he just was giddy about the stock itself and the performance and how well it had done in his portfolio and how well it was continuing to do. So you can have a lot of volatility, and you can still, have stocks that are doing what they really are meant to do and what we think they might do. Mark, we're also getting a question from John Greer, and John says, could he just see slide 7 one more time, please?
Sure. Before I head over there, this is what Jane is talking about, and we talked about this at a number of roundtables. You may recall that I selected OLED after this price drop and basically put another log on the fire, and that worked out pretty well. And again, the thing that allows you to do that is again that long-term perspective and the visual analysis, in my opinion.
Was that the night we both chose it, Mark, or was that a different night?
No, we did that originally.
Okay.
Back with it around 50, I believe.
Okay.
Okay, there is slide 7, if that's the one he's talking about, Ken.
It is, and then he'd like to see slide 8 real quickly too. And John, if we're not giving you enough time on these 2 slides, I want to make it clear that all of this is uploaded to YouTube. It'll be there tomorrow. and you can look for the roundtable or the Manifest Investing roundtable or the Mid-Michigan roundtable. They all will take you to these slides, and all of our roundtables and all of our investing topics, Turnout Tuesday programs are on that website for the last, maybe 8 years or so. So you can see those things tomorrow. Mark, I'm going to give you some good news here from Tom Jones. Tom says that if you go to the library version of Morningstar, it retains the old format and all of the old functionality.
Interesting. I'm going to make a wild guess that it just hasn't been propagated yet to that stuff.
Well,
I don't
it
know.
could be, but while it's there, you might as well, you might take advantage of it. So we're being told, folks, that if you really like the ability to see when things were added and left a portfolio and these mutual funds, that if you go to the library version of Morningstar, you still have the old format and the old functionality, and it's still working the way it was supposed to. So
I'm going
we'll
to check that
be
out.
all ready to go.
I'll be
Okay.
I'll be calling you for your library card tomorrow, Ken.
All right, that's something I will share with you, Mark, the library card, okay? I'm looking at my hands, and I don't seem to have any hands raised. I've covered the questions, Mark, and we're just about 5 minutes over our time limit, so we're in good shape. I just can't get over this picture here, so let's use a different one next time, okay?
Crystal Blue Persuasion.
Crystal Blue Persuasion. Okay. So it's time to say goodnight to everybody. And Mark, as usual, thank you so much for all you do for this program. And we hope to be together again at the roundtable on September 24th. Good night, everybody.
Thanks, everybody.